Okay, good afternoon, guys. Well, welcome to this FX Street special event, all about the Elliott Wave. So I'm going to give you my take on the Elliott Wave, what I think it's all about. I've got a standard presentation, like everyone does on Elliott Wave, but I've gone into the charts today and found an example of what I think the DAX is exhibiting in terms of an Elliott Wave. So we'll go through, discuss that. I'm going to go through the basics, we'll understand what it's all about. Key point is that Elliott Wave is a theory. So that's why I find it very difficult to trade the Elliott Wave. You don't know it's an Elliott Wave until it's an Elliott Wave. So the biggest opportunities need to be a bit of a leap of faith. So we'll go through that. We'll discuss it. Any questions you've got, guys, let me know. Again, I'm always open to questions. So let's get started. So before I start, as always, a risk warning. Remember that spread betting, CP trading, both carry high risk or capital with the possibility of losing more than your investment. These products may be suitable for all investors, only intended for people of the age of 18. Please ensure you're fully aware of the risk involved if necessary, seek independent financial advice. Education only. Content the webinars, person of the moderator, not a trade.com. The content is not constitute financial investment or tax advice. We recommend that you discuss your specific requirement and independent financial advisor prior to entering bet. In trade.com is not accept any liability of the content of comments shared through this session. So what is the Elliott Wave? Well, it's the theory that was developed by Ralph Nelson Elliott. That's where he gets his name from. So the wave theorist concentrates on the price and argues that the key market analysis is price action, which I guess is fairly standard. So the Elliott Wave is calculated and fundamentally based on the cyclical nature of markets. So they argue that the financial markets always work in cycles. I don't think any of us can discount that. But I think the key thing to any kind of trade, any kind of fundamental analysis, technical analysis, is understanding what actual cycle we're in. It's very, very difficult to understand. And again, when I talk about when we do our live trading sessions, that we're either focusing on the inflationary data or the growth data. And it's just the same when you're trying to interpret what the market's thinking technically. Are we still in that bullish period? Have we corrected enough? Have we overcorrected? And that's really what I think the Elliott Wave is trying to interpret. It's trying to understand that the market will move in predictive boundaries, predictive cycles and ways, and trying to identify that and catch it. So wave theory divides into the price actions into five main phases, and this is represented visually with the candlesticks or line charts. So I would never really use line charts for an Elliott Wave. Bars will work, but definitely candlesticks for me, because you get individual signals from the candlesticks, and that'll help with your confirming or contrary indicators. So the first one is the new trend begins to form. That's the start of your Elliott Wave. Then we see a corrective phase, which is common throughout the Elliott Wave. And then that shows some profit taking, and we go back into the initial trend that's formed, but we don't trade under the underlying trend inception point. I've got different views on this, so I'll go through that in a little bit more detail further on. Because that basically just means that if the Elliott Wave comes back to where you say the trend started from, then it isn't an Elliott Wave. And that's fine, I totally agree with that. But really, for me, for it to be an Elliott Wave in the first place, it would never get anywhere near that for it to be an Elliott Wave. It'd have to retrace more along the lines of my Fibonacci interpretations. So the most powerful cycle is the third part. Now, again, this is where people like to get involved and think they can make the most profit. Again, I've got different views on this. Again, you don't know this is the strongest part until you've identified phase 1 and 2, and you don't know how it's going to end until you've seen phase 4. So very difficult for people to get the most out of the third wave of the Elliott Wave, which is meant to be the most powerful. Then 4, we see the other correctional phase, which is very, very similar to the corrective phase in 2. Again, the same kind of rules. It can't retrace too much into that third phase or try and take away too much of the gains. If it does, then it is an Elliott Wave. So if you've made money in the third cycle, you've been fairly lucky. Then the final continuation cycle, that's, again, the bubble effect. That's where we've continued in the trend. The market's reached this higher high, and then we'll move into the corrective phase. So the fifth and the corrective phase for me are the most tradable parts of the Elliott Wave, because you know it's an Elliott Wave, and then you know what the boundaries and criteria you're playing with. Identifying the initial trend is easy. The corrective phase is just, again, a practical measure of understanding that point 1 is what it is. Okay, that is the start of an Elliott Wave. And point 3 is the most powerful cycle. But again, it's very difficult to know where to take your profit until you hit that fourth phase and you see some sort of correction. So again, it's trying to understand what you interpret by Elliott Wave. And that's the whole key to Elliott Wave, I would say. is that remembering that it's all about interpretation for yourself, but also interpretation of the market. So I like technical analysis that everybody else uses because it becomes self-fulfilling. So, again, a little bit later on, I'll show you about RSI, D-marker, and all these other kind of indicators I use because it's self-fulfilling. I know the majority of the market uses them. So if the market is overbought, I know it's overbought, and so does everybody else. Again, if you're interpreting Elliott Wave and nobody else in the market is, then it's not going to follow the self-fulfilling prophecy. And that's why Elliott Wave it's like a trader's dream. It's like using things like Ichimoku Cloud. When it works, it's perfect. Why don't you use it all the time? Because it's so unreliable. So again, when you look at Elliott Wave, why don't people use it all the time? Because again, it's so unreliable and used. It's not that it's unreliable. It's so open to interpretation that you don't have a reliable point in time. You don't have an indicator saying yes, overbought, or yes, this is wave one, or yes, this is definitely wave two. It's all interpretation, and it doesn't matter what indicator you take, what website you look at. It's all down to you. If you interpret that as an Elliott Wave, then you're trading in that mindset. But if everybody else in the market isn't, then you can't call it an Elliott Wave. Simple as that. So when you look at an Elliott Wave, for me, the basics, what you need to know, and I'm doing it on a line chart in a very, very rough, crude way, because you need to understand what it looks like. If it doesn't look as clear cut as 1, 2, 3, 4, 5 and lines, then it's not an Elliott Wave. So there's no kind of way of getting around this, unless it looks very, very, very much like this, okay, that we see a very strong trend, very small from 1 to 2 and 3 to 4 correctional phases, then it's not an Elliott Wave. Okay, it has to be on quite a fairly steep 45-degree trend, okay, and generally the Elliott Wave for me is on the upside. So what we're looking for is the market to go in a straight line from point inception to point 1, and it doesn't really retrace. Okay, we've just got a question coming up. Are you saying that some parts of the chart are Elliott Waves and some are not? No, I'm saying that the whole thing has to look like this to be an Elliott Wave. An Elliott Wave isn't, you don't know an Elliott Wave is an Elliott Wave until point 5. Okay, so it's simple as that. You can interpret point 1 to point 2 as the start of an Elliott Wave, 2 being the correction, 2 to 3 has been the strongest part, 3 to 4 has been the third correction in Elliott phase. But until you make a higher high in point 5, yeah, then you can't call that an Elliott Wave. So it isn't an Elliott Wave until point 5. Okay, it's as simple as that. Until it's made that higher high of the peak above 3, it's not an Elliott Wave. It's just, again, an Elliott Wave being formed. Okay? So the second part, really for me, is much more important than the first part. Okay, so the first part is just saying we've got a trend. Now, you're going to see trends in the market all the time. Again, the Elliott Wave, you have to be careful and use it on the right kind of time frames. If you're trying to use an Elliott Wave on a 5-minute chart, it's not going to work. All these kind of theories and all these kind of strongly believed technical studies have to be used on the right time frame. So minimum you're talking is 15 minutes. Realistically, I would say an Elliott Wave is hourly's absolute minimum. Daily is more probable than weeklies and monthlies. Okay, because these things take a long time to form. Then it takes a long time for the different parts of the wave to pan out. If you're seeing this on a 5-minute chart, you probably see 10 Elliott Waves a day. For me, I would say realistically start on the hourlies, but more probable, I would say for the Elliott Wave, in my experience, that it would be the dailies and probably weeklies that are going to give you the best results. Okay, now that means that it's quite difficult to trade from because you don't get that many signals. But as I said, I'm always prepared. I've got a live example of what's happening in the DAX, and I'll show you how to trade that and what I would trade it a little bit later on. So the second part is very, very important. It doesn't just confirm that we've seen the uptrend from the inception to point 1, that we've retraced. Now, I'd use my Fibonacci. You know how I use Fibonacci as one of my key tools in my studies. So what we're saying is that the point 1 to point 2 should not get below 8. So it should not get to the inception point that you've called the initial trend from. Okay, that's far too liberal. Okay, that's far too accommodating for me. What you need to be saying is that once we've identified the uptrend from point 1 to point 2, when the market retraces, for me, it can't go below 50% of that up move. So it can't get anywhere near the inception point of A. It can't get anywhere near that. If it does, it isn't an Elliott Wave. Scrap it. Okay, so I would say that it really, at the most, can only get back to 50% retracement of that out move. Okay, so again, I mean, if it doesn't start to look like this, then it isn't going to be an Elliott wave. So 2/3 is probably, a good rule of thumb. But I would just draw Fibonacci from the low to the high, so from the inception at A to the high at 1, and then see that 50%, and that should be the absolute maximum for me. More realistically, it should get to the 23.6, which is around about a third, okay, on that chart, and then that means we should see a bounce and start to see the third wave. So third wave is the largest, most powerful wave. So that's where people think they're going to make the most money. So you've identified an up move. You've identified that it's not retraced into that up move more than a third, more than the 50% retracement. So that's when the buying should really come back into the market. And that's fine. Okay, that's absolutely fine. That's not a bad way of trading. As long as you make that new high in B, then really the rest of it is profit. But for me, you don't know how much profit that's going to be. Okay, just because something's moved up from 0.0 to 0.1, retraced, and then from 0.2 has made that high. You don't really know. All you know that should, if it's going to be the Elliott wave, have the most momentum, and that should make a significant higher high. So what I would say, all you can really do with any kind of real confidence is just take the distance that the 0.0 to 0.1 has moved from to make that initial trend. So you'd say realistically that the third part, the most strongest part of the Elliott wave, should make a minimum of that. Okay, on the upside. You can use all your other things like your daily, weekly, monthly points of resistance. But realistically for me, the Elliott wave, that's why it's so ambiguous. That the Elliott wave tells you this is the most quick moving, the most trend affirming, the most profitable part of the wave. I just don't see it personally. I just don't see it. Okay, because where do you get out? This market could then correct at any point. So for me, yes, if it fills the criteria of a market going in a trend, not reversing its entire up move and then making a higher high. So realistically for me, that's not filling me full of excitement, to be honest. I don't get excited by the third wave and Elliott wave. And I'm sure you'll hear different presentations today where people will say that's where they make the most of your money. But, ask them, these other experts, how to explain where to get at and make the most money. Okay, I don't work off guessing. I don't work off, what could be. I work off facts, what's happened in the past to predict the future. Okay, so that's what I'll show you a little bit later on when I trade the reversal part of the Elliott wave, because I've got a great idea of what's going to happen. Because I know that it is an Elliott wave, and I know what's happened in the past and where it's gone to and moved to, so I can predict where it's going to go in the future. Right now, all we're doing is saying that this third green part, this third wave, is going to make us the most money. But how? How is it going to make us the most money? Just buy and hold on blindly? It's not the way I trade. So the fourth wave is just that other correction. So very much like from 0.1 to 0.2, you're seeing the market correct and profit take. And obviously, when the market's moving in a sustained manner, other people will take the opposite direction and push the market down. But the same rules apply. We don't get into the big range. So on that third wave, we do not, on the correctional phase, dig back down into that upward move too much. It has to be, like we say, these little kind of peaks and troughs, and then we quickly move up in the original direction. So again, a third of the move that we see in wave 3 is an absolute maximum. Again, I'd be more scientific. I'd do 0.2 to 0.3, drag a Fibonacci up to them point, then look what the 50% is, and it shouldn't really get anywhere near that. If that's the strongest move, it shouldn't get anywhere near the Fibonacci 50%. It should probably get to the 23.6 and find that as a significant bouncing point, and then go off to make the fifth wave and that higher high. And once you've made that higher high, we have the Elliott wave. But until we see that fifth point and that green line made, and it makes that high above the 0.3, you can't call that an Elliott wave. Now, it can make it by one tick, okay, above that point, that point part in part 3. It can make it by 1 point, and that technically is an Elliott wave. So again, very ambiguous to me, because just because it makes, that 1 pip higher high, maybe it then completely reverses and sells off very, very quickly. Or maybe it goes up for another 20, 30, 40, 50 ticks, okay? What I'm saying is that if it isn't an Elliott wave until 0.5, then really, you know, again, you might have made money on the initial buy from point 0 to point 1. Okay, took some profit when we dipped back down, then bought some more from point 2 to point 3, the strongest part, and then sold on point 4. That's great. That's great trading. Okay, I'm not going to take that away from anybody. You can then buy the dip at point 4, expecting the market to make a higher high, and it probably will do, because that then you have the 4 points making it an Elliott wave. So once you made that higher high, the market generally does blip up a little bit quicker, because people are just buying at that point to get that tiny bit of profit, because it's pretty much guaranteed. But once you've seen point 1 to point 2, point 2 to point 3, 3 to point 4, you've seen 4 waves of an Elliott wave, then you see that higher high. That's an Elliott wave. So you just make your tiny bit of profit on that final up move, because you can guarantee that you can call that an Elliott wave. Until that 5th point you made that high, you can't call it anything. It's just a forming Elliott wave. So what I like to see is that 5th wave, that higher high, use my technical analysis, and then sell it back down, because I know where it's gone, I know where it's been to, and then I can use other tools that we keep, you know, talking about. They're very important: the self-fulfilling prophecy, the RSI, the D marker, and our good old friend Fibonacci, and we can make much better profit knowing that that is now an Elliott wave and that it has to now correct in 3 waves. So just to kind of look at that in a candlestick view, you know, again, to look at it in the market, it doesn't look very, very attractive, but it's not meant to. What you see is a simple trend line catching the bottoms. And we see this Elliott wave form moving. You know, we see these 5 green candles, then we see a bit of a doji, come back down to the, you know, this trend line, market then hits, then we see the big, you know, big 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles making higher highs pretty much. Okay, so that's the big part of the move, the big part of the Elliott wave being pushed in. We then see the doji, the market then correcting the phase 4. We then make the higher high, okay, in 5, meaning that is an Elliott wave. So when you that's the reason why I showed you and then line chart to show you how conformist and to how clean it needs to look. It needs to look as good as this when you put it onto your candlesticks. Okay, if it doesn't, then it's going to lead to interpretation. It's going to lead to you getting into wrong positions and the market not interpret it in the right way. Okay, so it has to look very, very clean. Okay, green, minimal candles coming down for correction, hit the trend line and go back up. Correction phase 4, you maybe see the 3 candles not quite testing the level of support here, but then opening up on that level perfectly, then making the high within 3 candles. So that is a good example of an Elliott wave in candles. So what I like to trade is the post-trend. So this is what we call the 3-stage selling inertia. I like this much more than the actual Elliott wave itself. For all the reasons I've said, I'm not trying to be negative the Elliott wave. I'm not trying to say it's not a valid theory. But again, if you're just guessing at every point, is it an Elliott wave? If it isn't, it takes a lot of your focus away from your trading. It takes a lot of focus away from what you're trying to achieve. I'm trying to make money out the market. It's as simple as that. So if it looks like an Elliott wave, it probably is an Elliott wave. But why would I buy into it just because it's a forming Elliott wave? I wouldn't. So what I like to see is then 5 Elliott waves being made, that 5th point making that higher high, then all I have to do is pick the top of the market and I can sell with pretty much complete confidence, knowing that I've got some key targets for it to correct and that it's going to happen in 3 main stages. Okay? So this is what it looks like. You know, again, we've seen our Elliott wave here very, very clear, but the selling inertia, again, is very, very nice. What we do is we sell back down to point C. So we generally get to the low point of where the correction of the 4th wave was. What we don't do is then make a high. So when we get to this line A, we cannot make a new high. Otherwise, it's A, not an Elliott wave. Okay, so that's another thing. If we don't see the selling inertia, then I guess technically it is an Elliott wave, but it's not an Elliott wave in standardized practice, because an Elliott wave generally has to correct in the same way to be this pattern. So an Elliott wave for me is not the 5 waves, it's an 8-wave pattern. That we see the 5 waves on the way up, then 3 waves on the way down. That's a full completed Elliott cycle for me. And if you don't, then again, you've got the risk of the market just going up. But then do you see a 6-wave Elliott wave? I don't know. I haven't come across that. So for me, it has to behave in this manner, okay, for it to be an Elliott wave. So the strongest part is that we move back down, we find some support on the bottom of the fourth wave, where the market then went on to make the fifth wave of the Elliott. And what we do is we see a bounce, but we don't get back to that high. As long as we don't get back to that high, then that really is now the real point where we can start to put some good trades on and make some good money. So we've seen the Elliott wave finish, the market come down and bounce, okay, but it hasn't then made a higher high. That's the C is the most powerful part of the whole Elliott wave theory that I know of. So I'm going to show you, okay, the DAX now. I'm going to look at it as a weekly view. So I'm going to show you the Elliott wave that I see on the weekly. I'm going to go into the dailies to try and interpret that, and then use the hourlies to see how we trade. Now, as I say, you have to really look up the time frames, these Elliott waves, because I just do not use them in intraday trading. What I'll use them for is the higher time frame view, and then drag that down into more manageable time frames, and then use that for entry and trade ideas. So what we can see is the Elliott wave, for me, forming. See the initial trend going up, represented by this blue line. Okay, so in number one, we see the market hit to a point, and again, look at the Fibonacci. Okay, we don't get back to the inception point, which is 100%. We don't get back to the 50%. What we kind of find support is around about the 38.2, 23.6. That to me is perfect. Yeah, that's an uptrend. That's been reversed. It's not got anywhere near the inception of 50%. So that's point one and point two of the Elliott wave done for me. Point three, you see this long extended move, okay, much, much longer than where we identified the trend. Look how this blue line acts as support. We then see the fourth wave, the Elliott wave, come in. Now, this is where interpretation has to come in, okay? We see the market breaks down, okay, but it doesn't break below this trend line. It does break below the 50%, but it doesn't significantly get back into this range. Okay, so I'm only doing the Fibonacci from the lows to the highs here. Okay, but that just shows you that we haven't really closed below the trend line. But if you do a Fibonacci from the start of the move to the end of the move, you don't get anywhere into the middle of the range where 3 is. So it's still a valid Elliott wave type theory. So what we do is we bounce off that level of support. Again, we find great support on that 50% line at 9350 spot 95, and we've made that higher high. We've made that higher high by literally 2 or 3 ticks. So that, ladies and gentlemen, is an Elliott wave, and that's right now in the DAX. Okay, so this is the weekly chart on the DAX. That is a real live Elliott wave that we can trade from right now. 2 things, okay? Now we know that it's made that higher high, okay, with that little blue boxes at 5. So that technically is an Elliott wave. But we also know that there's a likelihood that we see that final bit of momentum coming to the 5th part, because everyone knows it's an Elliott wave. So we've seen some profit taking today over the last few days. We've seen the markets move down. Now, I'm not just saying that's because it's an Elliott wave or because it's technical trading. The markets have a right when these all-time highs to trace to whatever it wants. There's a couple of things that I'm looking for at the minute is that DAX, for me, really has been very strong out of the majority of indices. So I wouldn't be surprised if we try and test the psychological 10,000 mark. So what I'm kind of saying from here is that, okay, we know it's an Elliott wave. Okay, so until it breaks below this trend line, for me, it's still an Elliott wave, and it's still really in the 5th phase of this Elliott wave, which is meant to be quite a strong directional move. So what I'm looking for is the market to break this high here, to hit the 10,000, and maybe then get as high as the extension on the fib, the 161 at 133.080. Doubt we'll get to 11,000, but that's the potential. So if you're getting short off the weekly Elliott wave, if you do classes in Elliott wave now, then you're looking for resistance at 100%, these highs, and you sell back down, looking to break, okay, the 50%, and then get back into this range where the Elliott wave, 3rd wave, has really put that extra momentum into the market. But again, you have to kind of predict what's going to happen before it happens. So it may well go up, even though we've made the Elliott wave from this higher high in this blue square, or, okay, it's going to then find that is the Elliott wave completed, and then we just get all the way down to the 50% and the trend line, then around about 9350 spot 95. And then naturally, if you think the market is overpriced, we're going to see some strong selling action. The market get down to these lower levels. So that is, again, that is an Elliott wave in its entirety, okay, by the actual theory that was laid down. Okay, that is an Elliott wave. Okay, it doesn't matter. We've only made the new high by a couple of ticks. That is an Elliott wave. So how do we trade from that? Well, I'd go to the dailies. Okay, so if I'm classing that as an Elliott wave, then we start to see it looks a little bit more clear on the dailies to me. Okay, it looks a little bit nicer. That we hit this high here, so the 100%, where I've drawn the fib from, we've only really penetrated that by literally a couple of ticks. Then we see on the days, the market is at two real indecision points in this blue box here. Then the market again makes one final attempt to get them highs, but can't hold on to them, closes below them two indecision bars, and then we've started to make some lows. Now, I've been a big advocate of saying that, we on the daily charts, we just keep buying dips, okay? Because the markets are still very, very bullish in nature. So every time we see these long wicks on the bottom, we don't close near that. We close toward the midpoint of the candle, okay? And we just see these long wicks that are left. And you can see that 1, 2, 3, 4, 5, 6, 7 times. Okay, so that's still, quite a strong signal that the market is very bullish. Now we've made this kind of weekly Elliott wave. Okay, and we've understood that for this to be an Elliott wave, it can't get back above this 100% because, again, we need to see that selling inertia. So realistically, we need to then follow this trend line on the way up, okay, but not make a high from here and then start to break these highs and move back down. So I would say realistically, if the market on the dailies is going to act as an Elliott wave and we're going to start to get into this selling inertia, then we have to really follow this trend line down and get to these levels down here. So I would say realistically, we need to be getting down over the next few days towards this 9.350 spot 9.5 for then a really, really big correction to start coming into the stocks. So we start getting into all these tails, okay, and breaking back into these lower levels below the fib 50 down to 38.2, then finally breaking, okay, this big long weekly trend line that we drew in, okay. So that breaks at the 38.2 on the dailies, then really that is time for a major reversal. I'm going to see a big move down in indices. So if we just take that into the hourly scenario, then this is where it all really starts here, okay, for me on the weeklies and the dailies. So we see we've made that final attempt to break above the fib and the 100% on the weeklies. Then we don't. Okay, market then closes back down, opens up and goes down, and from that point, really, all we've done is sell back down. Okay, so from the lows to the highs, again, we've broke above the 50. And then we've got another target of that 50% on the hourly. So all the daily lines are still in, all the weekly lines are still in. So realistically, we haven't been able to push up again and break into these daily levels of resistance or get back to this 100%. So while we've got this big block that can't be filled, this big blue and black extended period here, there's still more sellers in the short term than buyers. So if the longer term buyers don't come in to push the DAX back to 10,000, okay, then we're going to then break down. So these blue lines really are just on the hourly chart, okay? So the long trend line that we saw on the monthly is way down here in the charts, okay? So we can't see that right now. This is just showing that we've got a predictive wedge forming here on the hourly. So the market's going to do one or two things. It's going to try and get back, yeah, and test these highs and get back to these daily and weekly levels and these highs in the Elliott Wave formation, or we're going to hold in this short-term hourly, okay, pattern and see the market at short-term support, getting the bias from that weekly potential Elliott Wave and selling inertia. Then when we break down these lows here and the 100% and we get through to the key 50%, yeah, that's when we're going to see some real hard selling, okay? So that's taking a weekly idea that we've potentially seen an Elliott Wave, so we could see that selling inertia come in. We've seen a daily view that we've really, these daily views are still very powerful. We've got back into this range here, okay, and at least sold down a token sell down. But again, we haven't made the highs yet. So when you look at that same view on what's happening right now on the hourlies, again, it looks like there could still be potentially more downside move, but that's going to pivot around here at 9609.97. So if we find support on that, the market could then quite easily, okay, on the hourlies by its own momentum, get to these daily and weekly targets and make some new highs up here. But if we start to break below the hourlies on the 50, then we're reconfirming on the weekly and daily that Elliott Wave type theory selling scenario could be even strong. So keep an eye on 9609.97. Simple as that. If we start to sell aggressively below it, we could really see that Elliott Wave type theory come into its own and see a selling inertia and sell down. If not, we could see new highs made in the DAX. We're trading right near it now anyway. So just look how the candles close on the hourlies. Because remember, hourlies are made up of, make up daily candles. Daily candles make up weeklies. We're looking at a weekly Elliott Wave type scenario. That could take 5, 10, 15 days, okay, to then give us true profit. But if you're looking on the hourlies, just around a pivot point that we're at now, then that's good enough for me, to be honest. So again, look into other things that can confirm your view. So on the weekly, where we drew that very, very powerful trend line and identified, we've got real two dojis here where the market's, again, double top, doji, market makes a new high here, but by a couple of ticks, and then we close with inside that. So really, for me, it looks like the DAX is running out of momentum. Okay, we can see the demarker indicator. We've got above the 50 point, but we're really getting nowhere near, okay, the overbought territory. So it looks like it's coming down for me and getting back, to be in a selling momentum. The demarker, again, definitely the bear reversal is looking to come into play. So we're coming towards the bull reversal at some point, but again, until we cross that line, there's still going to be more sellers. So I would say with the RSI at 58, the demarker at 0.4, two dojis, okay, shooting star type formation on the weekly is here. If this market then closes, so remember, we've got 10 days till this weekly close. No, we've got another 4 days to this weekly close. Yeah, if that closes in another doji, could see the market push down, increase that selling inertia and break and try and get down to this 50%, which is of the entire move. Okay, so markets are overbought mentally, and the fundamentals are saying that we've still got problems in Russia, still got the problems in in the wider economy with the Eurozone, especially the unemployment, possibility of Greece defaulting. So at what point is going to trigger this down move in the stocks? Okay, well, that blue line is from the start, okay? So the blue line is from the weeklies, okay? So from the start of here to here. So that is the weekly trend line that I'm basing the Elliott Wave upon, okay? So we haven't broken below it yet, okay? So from these lows here back in June 2012 onwards, okay? So that is that trend line here. So that is a real pivot point, real key point of where the market might test on the higher time frame charts. But again, look for it on your smaller time frame charts. You just draw that on your weeklies. It's very easy to draw. So I'm looking for the market to turn, okay, to not get above that 100%. If we don't, the weekly, that means it's confirming RSI. We then see selling inertia come in. So you see three waves, okay? Bang, hold this as resistance, then get all the way down to probably the 50%. So you've got maybe, I don't know, maybe 1,000 ticks potential downside in the DAX currently if we don't get above these new highs. Yeah, so that's again using the Elliott Wave theory. So let's just go back to the Elliott Wave. So remember that fifth wave that we saw before. Well, this is what's happening after 5 waves of buying in an uptrend. Okay, so after A, the market pulls back slightly with a period of red candles. It's only short-lived with low volume. See that by the short candlestick bodies, indicating shorts are more likely to be long covering. Then in B, the market rallies but fails to break the high set in wave 5. Okay, so that C is the correctional move is complete, and the trend reversal starts to take shape. So the market then falls away, breaking the new set in wave 4, and that indicates a sentiment change, and that's what brings people back in to selling the markets. So we can see that people were happy to buy if this was an Elliott Wave or not when we were just holding above the trend line. Once we break below the trend line and can't make that new high in B, as we've just seen in that DAX example I showed you, then when the selling momentum does come in, if we find that the previous low in phase 4 acts as resistance, not support, then even more people are going to sell, because that's confirming the selling inertia, which I think is much more powerful than the actual Elliott wave itself. Okay, so I've shown you the basic principles of Elliott wave theory, but we can put that into practice now. I'll show you the traditional way of trading the Elliott wave, and then you can either go with it or against it. I think I've proved my point that you can't call an Elliott wave till it is an Elliott wave in 0.5. And then, again, although I think the selling inertia for me is much more powerful, you can't prove it's selling inertia until you make that lower low on the third selling wave. So, again, it's all a big part of theory and how you interpret it. But if you want to trade Elliott wave as every other expert is going to tell you, then this is how you do it. 3 basic rules, okay? And you need to plan your strategy around this and have all your other tools, not just the Elliott wave, remember. So wave 1, the first part of the rule is you should never retrace that initial trend that you've identified 100%. Okay? I would say 61.8 of the fib is a maximum. I would say 50% personally for me is a maximum, but much more likely 23.88. I wouldn't want to see that move really more than a third of the correctional phases back into the initial move. Yeah, and that goes for the 5th wave. So the 3rd wave should never be the smallest wave. Wave 3 and 5 should be the longest. So again, back to that DAX example, we haven't seen the 5th wave give us everything it can. So there's every possibility that the market can go and make fresh highs and hit that 10,000 mark. The Elliott wave is by no way over and done with yet. But if we close and don't make them highs, then technically it is an Elliott wave, so we could see that aggressive selling. That's why it's ambiguous. So remember, wave 4 should never break back into the range that we saw in wave 1. So again, it's just making that the direction of the market is steady. We don't retrace at any point back into the initial trend too much. This is simple. That's all we're saying. Don't force the Elliott wave, right? You can't make an Elliott wave if it's not one. You can't make the 5 impulsive waves and the 3 correctional waves happen if they're not going to happen. Okay, again, always identify whether the wave is impulsive or corrective. If you identify an Elliott wave is an Elliott wave and it has made them 5 criteria, then it's much easier then to sell the 3 corrective phases, even if it's only 3 or 2 very, very short trades. If you know an Elliott wave has been formed, you know you've then got over 70% chance of this being a corrective phase. And if it isn't, well, it isn't. You haven't really lost anything. If it's gone up all that distance anyway, it then has to correct. It's as simple as that. And anybody can identify an Elliott wave after the 5 waves. That is for sure. So if a trend is forming and the wave has formed, always look for the signals that the next wave is on its way. So you can do that by, again, using a simple trend line, using RSI, MACD, or using individual candles. Okay, as data and information come out, the market will always either confirm or invalidate that you're in a pattern. But unfortunately, the market will never tell you that's an Elliott wave, as I keep saying, until it's made that 5th wave. So all the time, you're constantly reevaluating. So here's how you trade it. Example 1, we've identified that wave 1 has formed and wave 2 correction is underway. Remember the first rule, wave 2 never retraces 100% of wave 1. So what we've decided to do is wait for a bounce. Okay, simple trading. Yeah, and as long as we don't get below A, we buy on the trend line and then go up. So you could say that the trend line is just as powerful, really, is the theory of an Elliott wave. The only thing that would make you hold that trade longer above B is thinking that it is an Elliott wave. And until we retrace to the 4th wave, we don't get our profit out. How many people are going to do that? I don't really know. That's why I don't really kind of think that this 3rd wave is all that market analysts and technical traders think it is to be. If you're just buying on a trend line, it's a good buy anyway. Okay. So the rejection of wave 2 has led the market, okay, to go up. So that's meant to be the 3rd part. So you need to hold your long trade as long as you can. Now you can hold that until you see a red candle. You can hold it back to see a correctional phase or, a signal like the doji. So this doji, for me, is more powerful than Elliott wave. So this is a reversal signal at the top of an uptrend. That would tell me if I was longer to this point, I'd get out anyway. I wouldn't wait and lose all that profit getting back to the trend line. I'd get out. Okay, so what I'd be looking to do is just buy at wave 2 and wave 4. Yeah, if you've seen a correction, buy. Seen a correction, then buy. That's how I would trade the Elliott wave. Then the fourth part is just exactly the same. You've got back to the trend line, haven't broke through. Well, for me, it's just another buy anyway, isn't it? So just the fact that we do make the higher high, it's just an added bonus for me. And again, you see that we break above where this indecision was, but we don't really hold on for it for that long. It's only 4 candles. Okay, so it's nowhere near as long as the third wave. The market gets back down, and more importantly, we use this trend line as support resistance. So close below it, the market hits it as resistance, and then moves down. So that again is bringing into selling inertia because we've seen the 5th wave. We know that's an Elliott wave, but more powerfully is the trend line that we're acting as support resistance. So wave 5, obviously, after the rejection of the 5th and the final wave of this bullish sentiment, when that trend takes place, here's the key to look for the coming correction move. So again, we've maybe made our money on the 3rd wave or buying 0.2 or 0.4. We've then made that higher high. And then for all intents and purposes, that's the Elliott wave. If it makes a new high from there, I don't know what it is. Okay, there are no 6-wave Elliott waves. So if it makes a higher high from here, then that potentially wasn't even an Elliott wave. So what we then have to see is the confirming 3-wave selling inertia for it to make it a complete pattern. But for me, again, once you've seen that 5th wave, I'd be all about selling below that trend line. Simple as that. When we can't get back into the highs, I know that the market's going to want to correct. I know it happens in 3 selling cycles. I know what goes up, more importantly, must come down. So that's what gives me the confidence to start selling after we've seen that 5th wave, especially when we break inside that straight line trend. Very couple of important points to remember, okay? Deciding where each of these phases begin and end is up to you, okay? You're the trader. So you have to use something outside of the Elliott Wave theory. You have to use trend lines, as I've shown you, or candlesticks or other indicators. The fact is every person is different in their interpretation of Elliott Wave. So the theory will vary, okay? What I think is an Elliott Wave and show you doesn't mean just because I've got all this experience is what other people think, okay? It's just my interpretation. Each trader, again, will put their own improvements, put their own techniques around it. We use trend lines, Fibonacci, RSI, divergence. Technical analysis, the list is endless. Regardless of what happens, it either is an Elliott Wave and you're going to get on the back of that theory, the back of that market action anyway, or you're not. But again, don't rely on the Elliott Wave being the Elliott Wave, the answer to all your technical needs, because it just isn't. The most powerful thing for me is the correctional phases and using Fibonacci, okay? That is just the same as trading off a trend line. The Fibonacci, back to the 50% and holding above will just mean that there's more buyers coming back into the market. So that's just buying back into an uptrend. It doesn't have to be an Elliott Wave to trade that way. Remember, when you see these lines broken down, the individual parts of an Elliott Wave, okay, of the third part especially, can be an Elliott Wave. Okay, so you can see that the strongest part of the Elliott Wave can be broken down into many Elliott Wave. And that, where does it end? An Elliott Wave within an Elliott Wave? Is that really how we want to trade? Don't think so, personally. Stick to what you know, okay? Market's gone up, retraced, do a fib from here to here, we're above the 50%, buy into strength. Same with 0.4. If it is an Elliott Wave, identify that, where we've made the 0.4, the 0.5 has made a higher high than 0.4, then that's great. Then just look for the market to top out with the RSI and D mark, and then sell, knowing that you're going to have a good opportunity at least 3 times to sell back into this range here, because that's where the market wants to get to. So the advantage of the Elliott Wave is that it's quite a visual thing, okay? So if you're very, very into technical analysis and you like viewing charts and understanding how they work, Elliott Wave is a great thing to talk about, and it's a great thing to look at visually. Okay, it allows greater trade decisions and confidence based upon knowing that if you are involved in these rules, that you generally know what should happen. So you can hold on to trades for a little bit longer, again, if the theory and the Elliott Wave is what the market's taking for its own. And again, it allows traders to take a long-term view of the market. As I say, don't use the Elliott Wave on hourlies or 15 minutes, really. If you have to, of course you can. You're the trader. For me, the Elliott Wave is much more powerful on the daily and weeklies, okay? That's where you're going to get your idea of trends, your idea of trade entries, and then again, just drop down to your hourlies to get into them trades, but your targets will be on your dailies and weeklies. And again, your traders can formulate more complex trading strategies. And again, you can look at the 5th wave, for your reversal, and 3rd wave, for your strongest part. And it's up to you how you interpret it, again, and how you trade it. But for me, the safest part are buying them dips of wave 2 and wait for when they're on a key trend line if the market's going up, or trading the actual selling inertia after you've proved it is an Elliott wave by making that higher high in wave 5. Okay. Okay, guys. Well, that's pretty much my view on Elliott Wave. Just got a couple of questions here. What throws me off is the pullbacks, etc., with the second and third leg for its gal, rather than the one long straight move. Yeah, absolutely for its gal. I mean, again, the markets can be subject to fundamental data, can be, new news, new comments, and it's very hard for something to trade on the dailies or weeklies and not ever break out of these constraints. That's what makes it so difficult. So it forms a fifth wave. It's an Elliott wave, and then it don't form a fifth wave. What is it? Okay. Well, it's just market movement. If it doesn't form that fifth wave and make that higher high, then it is an Elliott wave. If it just drops off from that point, it's just another trading pattern. Just because it's gone up for 4 out of 5 phases in Elliott wave doesn't mean it's an Elliott wave, does it? An Elliott wave has to be that higher high in 5 waves. Otherwise, it's not. Okay, Mr. C, can you show again trading wave 1, 2, 3? This, do you mean, or further back? Back. This, or further back? One slide for every wave. This? No? Further back? Or is this what you're looking for? I mean, this is the Elliott wave, as it needs to be seen. Again, sharp directional moves, breaking back, not below the 50%, okay, and then seeing sharp directional moves back. Then again, all pivots around here. Once we made that higher high, we then have to find some sort of bounce at some point, but not make that high from where A is. And then we come back down and make them lows. Yeah, I mean, the whole point of the selling inertia is 3 parts. So once we see the market come down, okay, we're going to find some sort of resistance potentially at the low of the 4th Elliott wave, and then as long as we bounce off that, or again, make some sort of attempt to go up and take the market back in an up direction, that's fine. But what it can't do is get above A. Okay, generally it'll stop at the 5th wave. Okay, but if it gets above A, then it's the whole thing's not an Elliott wave or selling inertia. If it doesn't, okay, and makes that almost like head and shoulders type pattern, and it breaks that point at B, okay, that low of the of the 4th correctional wave, the 2nd correctional wave at 0.4, then that's when the real selling inertia comes. So that is the safest part of an Elliott wave for me to sell. So once we've made the Elliott wave, okay, this we know, higher high here, yeah. Once we've then not made a higher high on the Elliott wave, once it then starts to sell back down and break the low of the shoulder of the 2nd corrective wave, that is the most powerful part to me. Yeah, you can sell as much as you want there. Okay. How can we predict the range in time frames, 5-minute, 15-minute, hourly on the Elliott wave? Well, as I said, I don't really think the Elliott wave is meant to be used on the smaller time frames. I would say that really hourly is the absolute minimum you can go. Try using the Elliott wave on your 4 hourlies and your dailies. Okay, you need it to be self-fulfilling. The whole point of Elliott wave, it has to be self-fulfilling. So it's going to take a long time to permeate through the markets. So it isn't going to work on a lower than hourly time frame. It won't work on a 5-minute, 15-minute, or 30-minute chart. It's just not designed to do that. You need to see consistency. You need to see a number of candles closed. So it has to be, hourly and above. Did I skip through the disadvantages? Oh, yeah. Okay, well, Elliott Wave, again, is a theory. Again, interpretation. It's rare to have two analysts have the same ability to examine a chart in exactly the same way and draw the same wave patterns. It's very closed in the sense that it doesn't benefit from realizing that markets in general, just move. They move up and they move down and people take profit. A trend is a trend. The trend's more powerful than Elliott Wave will ever be. So drawing a straight line trend along the bottoms is much more powerful, in my opinion, than the Elliott Wave. All the Elliott Wave is going to give you is the confidence to stay in a trade for longer. And sometimes that's all you need, okay? Sometimes, you just need to know you're right with the trend telling you that, and you stay in the market longer anyway. So there's nothing to say that's a bad way of looking at it. But again, the Elliott Wave is all about hindsight. Until you see that fifth wave and that higher I'd made, it's not an Elliott Wave. So it's loads and loads of interpretation, loads of what ifs, and it doesn't give you the confidence. I use things like Fibonacci because they're real time. RSI, D-marker, Bollinger Bands because they're self-fulfilling. The Elliott Wave is a theory. I'm not saying it's a bad theory, but it's a theory open to interpretation. Okay? So always look for the overall trend and use things you know that work in the market. Okay? Okay, so some are saying that you're not buying dips at 0.2 or 0.4, but rather were to take profit using fib expansion. You have bought at 0.2 or 4. Well, that is one of the points. But again, it depends how you're doing it. I would take profit though because you're in an uptrend. Okay, so you're in an uptrend, so you have to take profit at some point anyway. Do that before it starts to hit down. All right, guys. Well, like I said, that's my view on my interpretation of Elliott Wave. As I say, it is a theory and it is quite a difficult theory to use. Key here is to use it on hourlies, dailies, weeklies, I would say, and above. Okay, guys, that's pretty much my time. So any questions, just email me at sruffley@tradermaker.com. Get me on Twitter at Steve Ruffley. Hope you enjoy the rest of the presentations, and thanks to the guys at FX Street. It's been a pleasure. All right, guys, have a great day. Thank you.